Bonjour everyone, I am Anne-Lise Cailliez and welcome to Parlez-Vous CEO, where we ditch the corporate talk and get real about entrepreneurship. Each week, I chat with founders and CEOs who build businesses their way, through the failures, pivots, and breakthroughs. And they bring the fire. Plus, I'll drop some golden nuggets of wisdom from my own entrepreneurial journey. This is your space to grow, learn, and evolve with a true growth mindset. Remember, success isn't about perfection, it's about persistence. Now let's kick things off and get this party started. Welcome to another episode of Parlez-Vous CEO. My name is Anne-Lise Cailliez and I am your host. My guest today spent 20 years as one of New York's top commercial real estate brokers. Then, in February 2024, he left JLL to start over. Stephen Palmese is the founder and CEO of Integritas Capital, a private credit firm that lends on major construction projects. In his first 15 months, he deployed 700 million loans, average deal size 80 million. He lent 125 million to an office to residential conversion in Dumbo, 155 million on Adam Newman Flows project in Miami, and has filed for a 57-story tower in Fort Lauderdale that he's developing himself. Stephen, welcome to Parlez-Vous CEO.
Thank you for having me.
In your own words, could you share a bit about your story and background with the people just discovering you today?
Sure. I could start at the end of the story. I did leave brokerage after a long career that started in 2004, but it really took me concerted efforts over the previous 12 years. I really started in 2012 creating efforts to eventually get me where I am. But I came out of school in 2004, and the school I went to was heavy on investment banking and non-real estate industry jobs. And so, but also keep in mind that the private credit for real estate wasn't a thing then, right? You know, Blackstone didn't have a real estate credit desk. It just, private credit in real estate didn't come to much later. And so I was looking for a job that literally didn't exist. The related companies, for example, was still an affordable housing developer then. And so even trying to find a job on the equities desk of a developer was still few and far between. So I ended up falling into a brokerage role for Massey Knakal, which ended up being was a boutique firm that had a sterling reputation. If not, it was the gold standard of brokerage because it was a conflict-free environment. And it was the only business that I had been in that was really truly dedicated towards the interest of, in this case, sellers that they served. So I was in brokerage for a while. The first inflection point was 2008. It was the financial crisis. I was still young in my career. Bear in mind, it was the summer of 2004 when I started. It takes a couple of years to really get your feet underneath you. So 2007, 2008 is when, if you're sort of plotting out what my growth path should have been, is when I probably should have been poised to have some growth. The financial crisis came, set the market back 2008, 9, and 10. At those times, I was, offered brownstones in Brooklyn Heights on some of the fruit streets like cranberry, pineapple, which today would have been 5 times more than what they were worth then. And so I often think back to, had I had maybe the mindset that I do now, there was definitely a business plan then to go out and aggregate brownstones cheaply. So needless to say, I stayed in brokerage 2012. The market started to rebound. That's really when I started, having a lot of success as a broker. The Commercial Observer even did an article on me. I sold, I don't know, it was 9% of all sales in Brooklyn in the first half of that year in 2012. Bear in mind, that was also the point when Brooklyn was becoming more institutional in size and scale. And so I happen to have the benefit of being the one who was representing most of the institutions or the independent property owners selling to the institutions. And so at the time, what I decided to do was, instead of leave the business to move to the principal side, which I always had aspirations for, I took what ended up being a long road. I started buying multifamily. So I started buying, 8 and 10 family buildings, which are called tax class 2B buildings. The reason why they're called that is because they've got limitations for how much the real estate taxes can grow. Basically, it's no more than 30% over a 6-year basis, 6 years. When compared to larger buildings, taxes end up being 30+% of the overall total rents. So it's really punitive in that regard. And on a building of my size, the taxes were 18 to 22%. So we started buying those assets. Meanwhile, I was developing a stronger broker reputation. And then the company I was at, Massey Knakal, sold to Cushman & Wakefield in 2015 and went to Cushman & Wakefield. I had a short stay there. Meanwhile, I was continuing to buy multifamily. In 2018, the same group that went to Cushman & Wakefield, and that was about the point in time I stopped buying multifamily. So I had put together 20 multifamily over about that 5 or 6 year period. The reason why we stopped buying is that for the first time in 35 years, the rent laws changed. That went from effectively being very pro-landlord to very anti-landlord. So we didn't want to sort of be in the fray of or in the wake of any policy change. So we stopped buying to our good fortune. Many people in the real estate private equity at the time had continued to buy through. And it's kind of interesting to see how they ended up navigating some of the challenges that came from the rent laws changed. And so sort of long story short, now that, it's 2026, all those efforts I started taking since 2018 led me to where I am now. And so we are a direct investor and developer. You mentioned a 57-story tower that we are developing in Fort Lauderdale. We started buying land in 2020. The idea was, how can we buy land for as close to zero as possible? And that naturally happens in the wake of, unfortunately, a dislocation in the market. That dislocation came through COVID. We ended up buying land in a part of Fort Lauderdale that didn't have, in my instance, zoning. That also had 7 years of lawsuits. So we took a pretty significant risk buying a property that had really no short-term visibility into what the zoning would be. But when you have a policy that is pro-development, then you've got a mayor and you've got 4 council members in Fort Lauderdale who are steadily trying to grow the market. We were successful in upzoning the property. So yes, we'll end up having unintentionally tied for the tallest tower in Fort Lauderdale. And then we have other projects that we will directly buy and develop on our own. Keeping in mind we're vertically integrated, that means that we would self-perform our own work. We are the GC in that case. We own interest in a concrete plant in New York, 2 in fact, and then 1 in Fort Lauderdale that we are in the process of opening. So we want to control as much of the costs as possible. My investor, one of my anchor investors, or angel investor, in his career has built 2.5 million square feet in that same regard. So we've been building Integritas somewhat similar to how our partner and our investor has built his business. And so that sort of segues into the credit fund, because we want to finance what we call, independent sponsors or tier 1 independent sponsors, right? So these are independent developers with sort of institutional-like platforms. It's not their first building. We financed a project that was a $63 million construction loan in Park Slope on a ground-up rental for a group that's built 40 buildings in the last 30 years. And so somewhat similarly to our dynamic, and probably intentionally, it's their own equity, so they don't syndicate. It's just the two different developers' money. They self-perform their jobs, which is similar to what we do, where they are the GC, and then all the subs are captive to them, whereby all the different elements of the trade are people that they directly own and control or are captive to them for a long period of time. And we take an extraordinary amount of comfort in that, because we'd like to be additive to our borrowers. It's suffice it to say that if we were to finance the related companies, I think with all deference to us, they may not gravitate towards some of our recommendations on how to build a tower in Hudson Yards. But when you have a project that's a mid-rise project in Brooklyn, there are really some exchange sensibilities between the parties. And then in the off chance that we end up having to take over the project, we have comfort in knowing that we could deliver for the same underwritten cost that the borrower has. So there you have it, very long-winded, somewhat boring. We are a developer, we are an investor, and we also lend developers with similar profiles to us.
So Stefan, you were a top broker after 10 years, top of the market. Most people in that position don't walk away. What was the actual moment you knew you were done?
I knew I wanted to be a developer from my youth. And I'm oftentimes quoted for saying that I would stand on the corner of 14th and 10th in Manhattan with my father, and we would sort of look north, which is now where Hudson Yards is, or even if you look south into where the Gansevoort market is, and much of that was not developed. And so I would have aspirations to want to be a developer. And so I just didn't realize how long it took to build a principal business career. So having fallen into brokerage versus the principal side and having gotten comfortable at a really friendly environment. Bear in mind, Massey Knakal is a place whereby 75% of the people who were there had their first job, and then they're there 10, 15, 20 years later. And then their colleagues end up becoming, their groomsmen and groomswomen, and then go on to becoming, godfathers or godmothers to their children. So it was extraordinary in that regard. It was almost like its own little snow globe, such a perfect little environment. And so that kept me very comfortable. And so perhaps took my eye off what it was to be a developer. We talk about in 2012, I ended up making the decision, opt for short-term, or near-term income through brokerage, right? Versus me in 2012 speculating on land, trying to implement a development strategy. Development takes 5 years. So I chose a little bit softer landing. And so as it relates to really where the inflection point was, I'm 44. I'll dial it back 6 years ago. I was 38 years of age. And that's kind of when it hit me for the first time that it's going to take me much longer than I anticipated to build the business I'm now building. And so that's why I started putting efforts in to, buying real estate in Fort Lauderdale in 2020, making moves in the New York market in sort of 21, and sort of building those foundational pillars that eventually gave me the comfort to leave in late 23. And so that's sort of where it was. There was I guess it was cold turkey, but it was 12 years in the making. And so oftentimes I used to regret the fact that I didn't leave earlier, or I didn't act on other points and times in the past. But instead, what I did looking forward as it related to COVID was a third inflection point, right? We talk about inflection point 1 was the financial crisis. 2 was 2012. The market was rebounding. There was another opportunity to become a developer. And then once I saw the dislocation in the COVID had created in the real estate market, I knew I wasn't going to have 3 strikes. And so that really was the moment I said, this is going to define me. And so that is eventually where we are now.
And so, Stephen, when rates spiked, most people in real estate froze, and you did the opposite. What did you see that they didn't?
That's the fourth inflection point. The market, we were investors and developers then, and we would lend ad hoc, but we weren't a stand-up, credit fund with full infrastructure. And so when there was the pivot from LIBOR to SOFR, followed by the 2021, 22 interest rate environment change, we took a look, and to your point, we saw that the credit markets and many of the stable New York debt funds in 22 and 23 had stopped lending. And so we took that as an opportunity to create a new book. And it's important to highlight that because we didn't have a legacy book. I didn't have loans from 21 that were made when the interest environment was much lower. And then now we're dealing with, sort of workouts or potential other issues. So we had raised over $100 million in 23 and made that announcement, somewhat publicly. And so what helped us to grow in 24, perhaps faster than, perhaps it was an expedited growth process, was we ended up getting phone calls from other debt funds, and they would come to us and say, we may not have all the capital to close a loan, or we lost a part of our capital to close a loan. Can you write an 8-figure check, and can you show up in 2 weeks? And so we had that ability to be nimble. We're very flat here. So as they say in Brooklyn, it's a very yes, yes, no, no environment. So we can do the loan, or we cannot do the loan. We'll show up or we won't show up. And so that helped us to build because we were partnering with other lenders. So I didn't have to worry about sourcing deals then. And so that worked to our advantage. And then as we grew into 2025, we recognized that partnering with other groups helped us gain growth, but we now needed to have full independence. And so, it's unlikely that we partner on deals moving forward. It's not that we won't. It's just that having our own standalone identity is probably where our focus is. And we've also built enough momentum to not warrant that. So, we're just rounding our 2-year anniversary. We've put out $935 million in loans. We are closing what will be our largest individual loan in the next 30 days. Call it by the end of April at this rate, but that'll be a $215 million construction loan. And that's in Jersey City. And I think that'll help build a lot more visibility for us because it plays into our deliberate strategy of financing independent sponsors with strong track records and institutional-like background. And this is in a market of Jersey City where there are 3 other institutional investors and developers who have built large towers around our sponsor. But our sponsor does not have the profile. So we spent an extraordinary amount of time, over a year in the making, to put together that loan and to get comfortable with the property that was already 8 stories out of the ground and technically was stalled. But we knew the borrower had very strong sensibilities, had been in Jersey City for a long time, had been formerly worked for, the Jersey City, had formerly worked for the planning and zoning board for Jersey City. And so we knew that they really understood the local landscape. So the perhaps a headline risk was not being able to reactivate a site that was stalled or not being able to get as much height and density as was anticipated when we presented the loan. And so all that said, we'll be closing that loan. I think it'll work out very favorably for everyone involved, but it's a good jump off point for us to build more national awareness that I think we have an extraordinary amount of capabilities, and hopefully that'll play out.
And the big institutions won't finance independent developers, but you build your business around the people they turn down. What are you able to see that they don't?
I like the way you put that. You have to bear in mind the institutions, in an institutional environment, there's a bit of a CYA mentality, right? If you're sitting around a board of 5 or 10 or 15 other, members of your company, and you're in an investment committee, and you are the only individual going against grain to say we should finance this $200+ million loan in a market, it's going to be hard for you to have the fortitude to look your other 15 peers in the face and say, if I'm wrong, if this loan doesn't work out, I would lose my job, right? So I fortunately don't have that dynamic. I'm not worried about my future employment. And also the number or sheer volume of loans that the institutions look at, oftentimes the business becomes a behind the desk business. I'm looking at an Excel model, I'm looking at a Google view, and through a cursory look, you very quickly sort of sift through what may or may not work for you. For us, what we're trying to do is spend an extraordinary amount of time with our borrowers because we want to build that rapport with them, really understand them and what motivates them, and understand their balance sheet, look at their projects. Again, they're going to be self-performing these buildings, so we want to see what else they built, who else they use for their trades. Oftentimes, we'll try to make recommendations if we have comparable capabilities to offer sort of some of the people we work with. And so it takes a deliberate intent to want to go and find those sponsors. And that's not to say that the institutions are doing anything, that doesn't work for them, but it's just a completely different business. Because just to give you an example, but if you're sitting in that boardroom, and I always use related companies or Blackstone as examples, but if you're in that boardroom and there's a loan and it's in a marketplace that's a tier 1 market with the related companies, which is a tier 1 sponsor, and everyone's going to put their hand up and say, we support this project because we've got confidence in, well, with Steve Ross, he's no longer there, but it's a lot easier to do that. And you don't have to spend as much of your time digging into the pro forma to confirm it's right, because by and large, the related companies has done this a number of times.
I remember once you mentioned that you told the developer to add a floor to their building before you'd land on it.
So that's true. And this was a very sharp Brooklyn developer who's not only in Brooklyn, landmark of his projects are here. And so this was an adaptive reuse building. And what he did that was very smart was he took what was perceived to be a too deep building to convert for residential, because it was a rectangle, a shoebox. So it was perceived that it was too deep. And so what he did was it has light and air windows on three sides. He set in the window lines by 12 feet across the entire building. So now each unit has an interior a little interior, not courtyard, but an interior balcony. And he took all that extra footage and added more floors. And so he did something that was extraordinarily creative, but we realized that he was underparked. And especially if you're going to sell condos in Dumbo, we believed you needed more parking, or at least a better ratio of parking than what he was offering. But what parts of Dumbo can get busy at the traffic level, at the street level. And so very simply, he had programmed condos on the ground floor, in which we had said to him, you set all these window lines in, you created all this additional footage to add more floors. What he had overlooked was if he just took the ground floor and made it parking, which would not count against his FAR, he could even add more floors to the building. And, it wasn't an aha moment to him, like he didn't have, but the fact that he was just looking at something in one specific way for so long. And it wasn't until you actually interact with someone who's like-minded, who's thinking about your project with the intention of trying to enhance it as if it was theirs, do you have this exchange thought? And he was like, absolutely. We don't need this ground floor. We could add more floors every penthouse space. And so that is exactly what happened on that project.
And Stefan, so you're closing loans and at the same time you're raising capital altogether. But it's really two completely different sales, different people, different language. How are you able to shift between them?
Raising capital is a full-time job. People, that's oftentimes said. It's absolutely true. Raising capital is a full-time job, and it takes you away from finding business and creating new relationships and focusing on growing your business. But you can't grow a business unless you have capital. So it is. From a timing perspective, it's difficult to manage that, but the language of raising capital is a language that I'm still working around. It's a different sensibility, and sitting in front of, every new, individual, family office, institution, life insurance company, endowment, they all have different needs. So really trying to understand what your counterparty is looking for, because we're largely construction. And so we're not going to be the best fit for every group who may have a not as much tolerance for risk or the perception of risk. So oftentimes I go into meeting with potentially an endowment that says we don't want the risk of construction. I actually end up trying to convince them that construction really isn't risky and that we're getting overpaid for the perception of risk. And I kind of just suggest, hey, if the property is taking place in New York, or the meeting's in New York, I would say, on your way to work today, or when you went to lunch, or you went out on weekends, how many buildings have you actually mentally cataloged that are stalled? How many can you think of? And so when someone actually spends a minute to say, you know what, you're right, maybe only a handful of buildings over the last 2 market cycles can you realize have been stalled. And so, but getting out of the ground in New York is tricky. You've got neighbors usually on 2 or 3 sides, and you need access agreements from them. And then you've got to, build the foundation next to theirs on a narrow street. So it's definitely not easy in that regard, but it is straightforward. And so if you know what you're doing and you focus on it, we firmly believe that, every construction loan we're doing we're being compensated for what we call the perception of risk. Because, fast forward to that same investor who says, hey, we want a building at TCO. I argue that there's more risk at TCO because the building hasn't been operational yet. You don't know if there are leaks. Is it watertight? Where are the issues that are hidden? And are you going to, lend on a property before it leases and then realize it has or needs all these other fixes? That's a scenario that I'd make up, but it's not outside the realm of possibility, because many buildings leak. There's just an article, I don't even know what periodical it was in, but parts of Williamsburg, all the buildings that are built, you think you're moving into luxury, and suddenly you're finding out that it's not as luxurious as it was designed. So that's how we're trying to navigate raising capital. But I think ultimately capital comes down to what we're now working towards, is having a balanced book, having a book with construction, and having a book that is offset with some existing. Overall, your returns won't be as high, but for marketing to the masses of investors, they may take more comfort in having a blended return. But I will still stand on my soapbox, and I will try to convince that life insurance company that they should be doing construction, but ultimately you want to swim with the grain and not against the grain.
And so right now you're running a firm doing hundreds of millions in loans with just 4 people. At what point does the machine break? And what are you going to do to make sure it doesn't?
We are 4 people on the credit side. We're bringing on a fifth, but you've got to keep in mind my infrastructure is a little bit more robust than that because I still carry with me a COO and a general counsel from when I started buying multifamily in 2012. And so I also have, accounting and bookkeeping and other folks who are in the background who may not be in that front four of Integritas, but are all, usually all hands on. And that relates to servicing and invoicing and billing and all the things that help keep the business streamlined. But I do think that bringing on another one or two is, so call that 6 is probably the right amount for what we're doing. I'm recognizing as the lending business is getting more competitive because banks are now back into the market. Banks are very aggressive. Rates are coming down. I think what we're at an inflection point and we're saying to ourselves is, I don't think we need to be a volume shop now because kind of what is happening, we're seeing groups now go to that were at 75% are going 80, 85%. And then their spread is coming down. And we did a loan in Park Slope that was 82%. But for someone we had a long-term relationship with, and what we thought was a bulletproof business plan as a rental on 4th Avenue. And so we'll do that selectively, but other groups that we see are now somewhat instinctively going to 80 or 85. You have to realize if you're at the earlier part of a market cycle, you will be largely okay. The market will continue to grow and you'll get taken out. But if you made that same 80 or 85% in 2021, not knowing that the market was going to turn a few short months later, then you likely are going to get wiped out. So we're trying to take the position that we want to be disciplined. We are desirous to put out large quantums of capital, but if we just need to be more selective and build more of a reputation for being more complicated or more complex, or finding sites that are challenged and really need capital, and that allow us to maintain the strong returns we have, I think that's a strategy that we're at the moment going to stick with. For example, we're closing on Tuesday, on Monday. Today's Wednesday. On Monday, we got a phone call that a borrower needs to close in 1 week, in 7 business or 7 days later, the next Monday. They were buying an assemblage of assets, and there were some thorny parts to it that their lender was no longer going to be able to close and meet their time of the essence closing. We got that phone call. It's perfectly consistent to what we want to do, required us to get smart on something that has a lot of hair on it, but we feel comfortable with. And we're now going to rush and close that project, and we're also getting compensated accordingly for it. So it's now just sort of maybe finding more of those opportunities. That is probably where we build the reputation on. And then that'll beget more capital. And then, I end up getting a phone call from an insurance company saying that they want to potentially do bridge lending with us. And so then you can maybe grow more organically. But yes, it's having patience is a strategy. It took me a long time to realize that having patience is a strategy because, when you grow up and you're in the brokerage business, it's frenetic energy, right? And, it's like you have to be the shark. You have to move even while you're sleeping. And if not, you'll die. And so that's also kind of who I am. And I remember when I was a boy, I would get a haircut, and one time I was moving so much that the barber slipped, and I had like a big, razor through my hair. So my mom would say I have ants in my pants. I think today doctors would probably call it something else, but taking a long time to realize that patience is a strategy. Let the market unfold. Find the opportunities that are right for you.
What are the traits of personality you're looking for when you're hiring?
I still look for call it old school at this rate, or just fundamentals of mindset. Again, when I was in the brokerage business, I was getting first in, last out. And so that's the approach we want to have. Someone who's willing to work hard at a young age. Doesn't mean that you can't go to the gym. Doesn't mean you're not getting your personal time. But it means that you're committed to the job and that you're committed to getting it done in the time frames required. And so, we've got a 28-year-old who does jujitsu, and I know that's important to him. for a variety of reasons, from a training perspective, from sort of getting his downtime and having, a mental reset. Let him work it into a schedule, but he comes back afterwards and he's committed to working with us, and he's committed to solving problems and even undertaking, other people's work to say, hey, I have an idea. Here's how I can help you. So someone who looks at the business like it's theirs, it's like, going to a restaurant and a waiter treats the business like he's the owner, right? Which is, the mindset I'm looking for, because, it's having someone who's looking after your collective best interest ultimately is what it is. And by the way, most of the people we're interviewing have very strong, underwriting credentials. But even the people with the strongest credentials may not have in the field experience, right? And this goes back to my point about the institutions previously. There are people we're interviewing who can model a project, but they need to get into the field. So there's still many things that I can teach them that they haven't quite learned. But that same individual at that institution is being asked, hey, would you finance this project? And yeah, maybe you went on one property tour, but that's not being on that site, 5 times a week, or, stopping by once a day and really understanding the path that it's on. So I guess what I'm looking for are people who want to learn, who don't have big egos, who are capable of taking correction, working with others, and wanting to develop the business as if it was theirs.
I love that. I love that angle of treating the business as if it was theirs. I think that's a great tip for anyone who is hiring. And Stephen, take away the targets, the portfolio, the scale. What's actually driving you? And what's the real answer? What's your big why?
Maybe it's an emptiness. Maybe there's just even this hollow on the inside, right? It's probably what it is, because I just have like this deep burning passion to build a large scalable business. In this case, the application is credited real estate, but I have just like a burning sensation to want to do something significant. And, I defined, how do you define significant? How do you define happiness? What does that mean to you? But I am deeply burning to build a building that I deem significant. It happens to be large, it happens to be even bigger than that. I don't want to just build one building in a market. I want to build out a community. Our product in Fort Lauderdale, there is a possibility it becomes a master plan of 25 acres. And now we're not just building one building, and we're building, a community within a community. I can't articulate why I want to do that. I also wanted to be an actor as a kid, and I wasn't good enough to be an actor, right? So, there are I want to be a singer. I'm just god awful. I can't even sing well in the shower. So, there are passions that I have, I'm just not good at. I think I'm okay at real estate, which is something that I think I'm okay at. But that's sort of what I'm doing.
And when something goes sideways, and in this business, things go sideways. So what do you actually tell yourself? Not the version for the team, the real one.
If you look back at the financial crisis of 2000, and even look at what happened in COVID and what happened in the environment, the interest rate environment shift, I think human nature's reaction is to not fight, right? Is to again, it's hard to, in 2009, and your lender stops lending on a $125 million construction loan because that lender's having insolvency, and then you have an equity partner, and they've got $35 million in a project, and then you're the developer and you've got $5 or $10 million of your money in this project, and that's your entire life savings. And everywhere you turn, the signs are this is an impossible out. That hole is just getting smaller and smaller. How are you going to battle Wachovia? How are you going to battle, large institution? So most people tend to walk away, and they could just say, I've tried, but actually recognizing that the folks on the other side have a little bit of leverage on you, but most people don't expect to get, I'm not going to say punched back, but they don't expect to get pushed back. Or someone really with which requires of it. This is part of what we want from our borrowers. If your entire life savings is in your project, that says a lot about your conviction in your project. Okay. But at the same time, if you don't have the net worth and liquidity to defend your position, you're going to get wiped out. So being able to have your own balance sheet and support to weather a storm is what I think we really look for in our borrowers and we expect for ourselves. We are taking on large scale projects, but we are not taking on projects that we don't believe that should there be a downturn that, it's like when the tide goes out, we'll see who's swimming in no shorts. We'll be able to do, sort of defend our position. And so that's what the mindset we have. And by the way, the story I give you is a story that, one of our angel investors has gone through, took over projects at a point in time when most people were walking away from them. And so I think that it says a lot about an individual. So when things go wrong, you also have to, keep your cool about it, because I don't think that saying things out of passion are going to go far, especially when you need the person on the other side of you to, move in your direction and help you. Even if your interests may not be aligned, you really need to maintain poise and sort of just think before you react is probably what it is. That's probably the most crucial part of it.
One day I remember you told me you don't burn out. What does that mean?
I don't know that I have the luxury of being able to burn out right now, because if I were to burn out, then that would be a problem. So I think what my mind is doing is probably like just sort of like moving forward the burnout to a point in time when I have the ability to do it. But there is an expression, if you want to get something done, give it to a busy person. And so we continuously create bandwidth. So I will probably be due for a burnout. And just right now I'm focused.
No, I hear you. I feel the same way. I compartmentalize the burnout. I'm like, later, when I'll have the time, I'll burn out later. I hear you. 70% of my audience is female, and a lot of them in sales and building their own businesses. And you've spent 20 years in some of the most competitive sales rooms in New York. What would you tell someone early in their career, especially a woman who's trying to build the kind of confidence it takes to get taken seriously in those rooms?
The way I looked at sales, let me say it differently. I didn't look at myself in the sales business. I just looked at it as having candor and speaking to people truthfully about the thing that I was asked to do, in this case, sell their buildings. And by the way, go back to 2004, there wasn't as much availability of information as there is today, right? And so people needed to rely upon the fact that what I was conveying to them was factual about what was happening in the market. And so I knew that I was working in an environment where people were a little bit too fast and too loose and were potentially looking out for their own interests. And so I knew that if I was going to have success representing, and I sold properties for mom and pop property owners. These are people who weren't real estate professionals for a living. Most of the times they inherited the buildings, and they had primary jobs. And so I knew that the only way to have success was to do very simply, show up on time. 90% of life is showing up, right? And so when you look at a sales job, how oftentimes are people actually canceling, or they're late, or, it's like, I'll do this tomorrow. So like, show up on the time that's required and just be candor. People didn't think I was salesy because I was just relating to them like I'd want to be related to. So I think, but I also had real estate related to me, right? I understood real estate and how it fit into its environment and what it meant for, again, person's home is usually their largest asset. Now take a piece of commercial real estate. Unequivocally, it's their largest piece of real estate on their balance sheet. I wasn't going to convince someone to sell a piece of real estate, but I knew that people who wanted to sell, were inquisitive about selling, were desirous to sell, they wanted information to be informed. So I used to say I'm in the information business, information and relationship business. And that if I steadily gave you information that over a period of time you knew was timely and accurate and without bias, that ultimately you were going to select me for your thing. But also I was thoughtful. I thought about you. I called you regularly to a point where you would say, how is it that you were remembering to call me? I'm a small mom and pop. You're still thinking about me. So, it's thinking about people, and it's being authentic in your approach that early on is what set me apart. Because let's face it, real estate does have a dynamic of being fast and loose, and just people wanting to convince someone to well, then it's lease the first thing or buy the first thing or sell the first thing for the first price that, they don't want. And so I was never anxious for a sale. I was never anxious for a sale to a point in time whereby I knew that the first bid was the best offer. But I also knew that my seller was not going to take that bid for a variety of reasons. And I was oftentimes saying, this is our best bid. We are not going to take it. It's going to take us some period of time to get smart on it. We may or may not match this price, but what it's going to do is we are going to learn. And so I think people gravitated towards that. Being a woman in the business, which is in a male-dominated industry, is challenging, but that challenge is your benefit, and being strong-minded in that space, I think will separate you apart. It's, I'd imagine it's a little imposing to say, hey, I'm in a room full of men and, how do I stand out? But I think each one of those men is just as uncomfortable in their shorts as you are, right? They don't have any more, confidence in themselves than you do. It's a room full of insecure people. It's just, who masks it the most, right? That's what it is. And so we're all people at the end of the day, each facing our own insecurities. And it's a function of how you manage that and how you maintain confidence in that. They're always looking for you to break character. They want to categorize you, like men are, jerks, but, a more derogatory term, and women are, like people want to see that out of you, but don't evoke that. Don't give them that. They stay tried in where you are. And, most people are going to realize, hey, this person has much more working knowledge than anticipated they do. They're the master of the thing that we're talking about. So I don't know if that was really helpful, but just, if I'm going to sell anything, I'm going to hopefully be the most informed person on that. I'm going to let my confidence in that ultimately speak for me. And so I think whether or not you're male or female or otherwise, I'd like to think that that'll hopefully trump anything.
Yeah, I love that. I think it's a great piece of advice. So, Stephen, what's coming up for you and Integritas over the next year, and what should people be watching for?
We are starting to see opportunities on the equity side, right? So on the investment and the development side, in particularly in New York. And so I live in New York. I'm from here. We haven't had as much visibility here on the investment development side that we've had like we would have had on the credit side. But we are starting to see a number of opportunities on the acquisition side from buying assets and developing them that I do think we'll have some success on. So I do think you'll start to see some acquisitions associated with what we're doing. I do think on the credit side, we're going to continue to build awareness for being a lender that we believe has unique skill set. I know many people like to sort of broadcast themselves that way. I just know that with every individual conversation that I have, I think we prove people wrong and they move in our direction. My only gripe is that I'm not in a room full of hundreds or thousands of people. My message has to be done, sort of one at a time. But I do know every conversation we have, we are changing people's opinions. And I would like to see new growth from the credit side as well. And so that is sort of where I think the next year will take us.
And where can people find you, Stephen?
I gave my phone number out on a podcast. So, you can call me, you can text me. Mind you, by the way, for being years in brokerage and having signs on buildings, I would get text messages from like the Verizon guy. He's like, hey, can I get into the building right now? I'm like, I don't own the building. So if I give my number out on this broadcast, I can't get any more calls from strangers than I normally get as it is. So, you can call me. My number is 917-544-90. You can email me. Our webpage is integritascap.com. My email is on there, so I don't have to repeat it on this one. But I'm in New York. I'm pretty visible, I'd like to think. I'll respond to you if you want to message me on LinkedIn. So I'd like to think, give me a call.
Thank you so much, Stephen. It was really a pleasure to have you today on the show.
Wonderful. Thank you.
And that wraps up today's episode on Parlez-Vous CEO and a special commercial real estate series. I'm Anne-Lise Cailliez, and I can't wait to join you again next week. Thanks for listening to Parlez-Vous CEO today. If you enjoyed the show, leave a 5-star review. It helps us keep going. And connect with us on Instagram at Parlez-Vous CEO. I am Anne-Lise Cailliez, and I know some days are harder than others. On those tough days, think back to why you started. What you're doing today matters, even when you can't see the results yet. Ideas are great, but it's what you do with them that counts. Find everything we talked about today at parlezvousceo.com. See you next week, and you've got this.